Everybody, welcome to Wiley Solution Walkthrough. This is Accounting Tools for Business Decision Making. This is the 8th edition, and this is problem 18-5. The textbook authors are Paul Kimmel, Jerry Weingant, and Jill Mitchell. The question used in the presentation is copyright 2022 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of myself and not the authors of the textbook or of Wiley. Okay, so what we're going to go ahead and do right now is let's go ahead and take a look at this question. So we've got Mary Willis is the advertising manager for Bargain Shoe Store. She is currently working on a major promotional campaign. Her ideas include the installation of a new lighting system and increased display space that will add $29,000 in fixed costs to the $270,000 currently spent. Additionally, Mary is proposing that a 5% price decrease of 40 to 38 will produce a 25% increase in sales volume. Variable costs will remain at $25 per pair of shoes. Management is impressed with her ideas, but concerned about the effects that these changes will have on the break-even point and the margin of safety. So prepare a CVP for the current operations, and after Mary's suggestions are introduced, show the column for total amounts only, what changes, we suggest. So let's go ahead and take a look at this. So our current situation, got sales less our variable costs is going to give us our contribution margin, less our fixed costs is going to give us our net income. Okay, so our units per unit total. So right over here in terms of our sales. Okay, so this right over here, let me just make this a little bit bigger. Okay, so this is existing. Okay, so in terms of sales, we right now have over here, the per units for sales is 40. And this is our current situation. Okay, and we're currently selling 20,000 units. So our total sales are going to be 800,000. Our variable costs are basically over here. Variable costs will remain at $25 per unit. So if we're sold 20,000 units, we're going to have variable costs of 20,000 units. So in our contribution margin over here will be 15. So our variable costs are going to be 20,000 times 25. And then so our basically over here, our contribution margin is going to be 300 grand. Our fixed costs are 270,000. And so our net income currently is going to be $30,000. Now, as we go through here and looking at it, this is our existing, right? So what is going to happen with the new stuff? Okay, so the first thing that's happening is our new sales are going from 20 to 25,000. Okay, so, and our per unit sales price though is going from 40 to 38. Okay, so our volume's increasing, variable costs will remain the same. And then over here, but our fixed costs, because we're having this increased display space, is going to go to increase by 29,000. So this is going to go from 270,000. We're going to add in another. So over here, by going through and doing this, I have a real strange feeling I've actually seen this question before, so I may have done this before. So over here, by going through and decreasing the sales price, we're actually increasing the fixed costs, we're actually losing money. So Mary's idea, just from a financial standpoint, doesn't seem to make a lot of sense. So over here, prepare cost CVP with the current operations and after Mary's changes are introduced. So would you make the changes suggested? And the answer to that would be absolutely not, because you're actually losing profitability by adding in those fixed costs and then by decreasing the sales price per unit. It's not going to be good. Okay, compute the current break-even point in sales units and compare it to the break-even point if Mary's ideas are implemented. Okay, so the break-even point in terms of sales units, just if you've been watching the other videos, it's going to be our fixed costs divided by my contribution margin per unit. So this over here is going to be our fixed costs are at 270,000. My contribution margin per unit is at 15. So the number of units I need to sell to reach break even at the current scenario is going to be 18,000. If I plugged in 18,000 to this right over here, there you go. You know it works, right? Okay. So we've got that part over here. Now, what is it going to be down for over here? Well, our fixed cost for the new scenario, this is going to be at 299,000. My contribution margin per unit is going to be at 13. So over here, believe it or not, our, to break even under this scenario, we actually need to hit 23,000 units. Let's just see if it works. There you go. It works. Okay. So over here, the answer to this one over here would basically be 18 and 13,000. Compute the margin of safety ratio for current operations and after Mary's changes are introduced. I'm not going to do that just because it's not something that I go through and do, but let's take a look at the solution and see what it says. Okay. 30 and 26, that's what we got. And the current margin of safety ratio, okay, so this is a break even. This is what we're currently selling divided by what we're currently selling. And so you're going from 10 to 8%. So, this is, again, it's not acceptable to move forward with the proposed changes. So, and if you want me to do this right now, and again, I just don't use the margin of safety ratio. It's not something I'm going to be testing in my class. So in any event, I want to thank you for being here today. And if you would like me to compute the margin of safety ratio, these are your instructors asking it. You can ask for it in the comments and I'd be happy to go through and detail it out. In any event, I want to thank Wiley for allowing me to continue to do this. For how much long, we have no idea, but I want to thank him anyways. Please don't forget to like and subscribe. If you're looking for other solutions, please feel free to ask for them in the comments. Have a great day.